Alright, what's going on everybody? Mando Trading here, and in this video I'm going to be talking about my trading model. This strategy is one that I use in 90 to 95% of the trades I take. I am starting to incorporate one additional little setup that I can use to my benefit. So I'm kind of in the process of back testing that right now, but right now this is it. This is the model that I use for every trade. It's one that can translate well through different time frames as well. But before we get into it, just make sure you like, subscribe, share the video, do whatever you got to do, and I'd appreciate that. So let's get into it. First and foremost, this is going to be the first of multiple videos in which I dive into live examples. Now, I've been posting on TikTok, Instagram, even on Twitter, videos, and those are live trades that I'm taking in Discord. And you'll notice now after I explain it in this video that a lot of those trades look very similar, and it's because it's all coming from one setup. Nothing really is changing. I'm totally against the idea of chasing a trade when something takes off and you're trying to take a crack at it trying to catch that breakout or something like that. To me, that is just not a sustainable model. So for this model, it's important to have a basic understanding of three concepts. These three concepts are all derived from Smart Money Concepts, or ICT. I can link the videos in which those are taught down below in the description. So the three being: one, liquidity. Having an understanding of liquidity is really the most important thing to me, anything trading. The second would be the idea of a market structure shift. Which direction do we think the market is going to go, and why do we think that? And the third being a imbalance, a fair value gap, an order block. Those are, or a breaker even. There are multiple different what he would call a PD array that I've incorporated into my model here, and it's all coming in a specific level that is derived from my market structure shift. And where I'm taking profits or targets is the liquidity. So it all comes together in that way. Now, while I have back tested this, I use it every day. I try and post, I really record 90% of the trades that I take, and I do that because I want to one, use that for my own study and my own back testing, but also just to share with you guys. And now you'll be able to see after seeing this video and the breakdown, how all these trades are pretty much the same type of thing. So, all right, now, to get into it, just briefly, of course, like any other strategy that you would ever use, none of these are 100% effective. There are certain times where, you might get a market structure shift, and I have my setup all there, it's perfectly there for you, and it breaks down and it heads lower. A reason for that happening would be, potentially we ran into a higher time frame level or resistance, that kind of shifted market structure, shifted the momentum of what we were playing. So, again, it's nothing is going to be 100% effective, but even when it doesn't work in your favor, you always have a clear-cut criteria in which you can kind of make your decisions off of. So let's get into it here. So right now, obviously on the screen, I have the S&P 500 SPY 30-minute. So for anybody who's followed any of my content in the past, that I chart on ES and NQ, and those are the futures tickers for the S&P and for NASDAQ. And the reason why I do that is just because I'm getting more of a sample size. I'm getting additional levels from the overnight sessions from Europe, Asia, wherever it may be. The market is alive in other places. So to me, rather than having a gap, I would much rather have specific levels that I can use and throw those in throughout the day, and that'll be an extra layer that I might have that others might not. So but anyways, for now we can look at SPY. It's fine. So I'm looking at SPY in the 30-minute time frame here. So this right here is a bullish imbalance or bullish fair value gap right here, and we can zoom back to see where that came from and where that was originated. So this dates back to Wednesday, July 12th, and just to give a basic little overview on what it is and what it looks like, I would recommend that everybody kind of take a look at some of those videos that I spoke on before, because that is a crucial component to my strategy. And I'm going to show four examples of this, two that perfectly meet my criteria, two that I would absolutely take trades on if I were to trade individual names, and then there's two where the idea still worked, but it wouldn't be as favorable for me to take it, and I'll explain why when we get into it. So first and foremost, we will go into SPY, and as you can see, we take a bounce right here, right? So what I'm looking for up until this point right here, we are still currently in a bearish structure, right, or a bearish trend. And the reason I say that is because every time we take out a low, to me, that is remaining in that bearish stance, right? If we don't take out a high, to me, nothing changes. So even on this little price run here, do we really take out any highs in this process over in this area? Not quite. So this would remain bearish, and you can see we take out another low. So from this point here, we have our low, we have our bearish market structure. Now we get our shift. Where would our shift be? So what is our recent high that we had? We have this high here, and we have a couple in this vicinity here as well, right? So what price run was it that took out this high right here? And it was this one right here. So this is where I have my fibs. I'm not a Fibonacci trader by any means, but I do use them for measurements. I think that it's a great tool to add just to have an overall understanding of the range that we're trading in. And again, you're going to see why I use it and why I feel like it is important. Well, it's extremely important for me, but why it would be important just for anybody really who's just trying to understand, what is the trading range, where might we run into some trouble, where might we run into some level that could offer us a bounce, little things like that you can incorporate that'll hopefully be helpful to you. So anyways, yeah, we took out this swing high here, or even these, right, with this price run here. So this is where I'm mapping out my fibs, right, from low to high. Now we come back over into here. So right off the cut, I'm deleting this just for a second. I personally I don't want to try and catch this, right? Because I know when liquidity or swing high is taken out, oftentimes that is taking out stop losses just in order to generate another move. Could it be up? Yeah, and that's when you get those breakout trades, but those don't happen quite as often as liquidity grab and retracement back down lower, where you're taking out stop losses and heading back down. So from this point, right, could you short this? And I actually made a little bit of a video on this the other day. Could you short it? You could try, but you don't necessarily know where this high is, right? You have the range set, sure. But for example, I mean, this is really a small sample size, but for example, let's say you caught this to the absolute tick, right? And you said, okay, I'm gonna, place my stop loss right above it. There's a chance that, with that short, right, we obviously ended up down here, so you'd be in the green for a moment, but price came back up and you actually would have been red on that trade. So a lot of people tend to get stopped out on that, myself included, when I do try and jump the gun a little bit and take those shorts, because I really want, and I'm expecting price after a high or low is formed to be retracing back down into what ICT would consider that optimal trade entry. And what that is down into this 0.62 to 0.79 range. Now 50% Usually that tends to be a battleground where you see this type of price action here, where it really is a battle. Are we remaining bullish? Are we going to be bearish? And there are times where, if you're looking at both NASDAQ and SPY, you'll see that, sometimes, let's say, SPY gets down into, this, golden pocket little area, this 0.62 to the 0.79, and NASDAQ, it will just tick 50 and take off, right? Especially if there's an imbalance in that area. So, for me personally, I would prefer, the lowest, in a sense, imbalance that has occurred. So in this price run here that we're looking at right now, we have one, just one. And here it is. You have wick, body, wick. This is your fair value gap right in this area here. And it is, right, it starts a little bit above 50%. So now how would I play this? How would this make any sense to anybody, right? So essentially what I'm doing is, as I'm seeing this form, I'm starting to salivate a little bit. I'm getting ready because I know once we get a high set, right, typically, I would wait to even throw this fib on until I saw a high get taken out. But as that high gets taken out, I'm waiting for this retracement back down lower. Now, with these imbalances, this one started at least above the 50%. I'm not looking for those. Sometimes there could be an imbalance up here. I'm not looking at that one as a viable entry or exit. I'm not even trying to play that. If it bounces into it and takes off, it leaves without me, and that's fine. I'm looking for the best risk reward. I want them below the 50% level, which would be considered a discount on your long, right? If you're buying up here, you're buying a premium at a higher price. Whereas if you're letting it get below the 50% of it, that would be considered your discount. So as price retraces back down, in situations where this happens, you could check the videos that I use, where you get a little bit above the 50%, and the imbalance drops down a little bit lower. I tend to not enter this trade until we get to at least the 50% line. Now, sometimes that range can be really, really big, and if that's the case, I'll try and crunch it, and I'll try and look for a lower entry point within that same imbalance, but not always the case, right? Because, again, the wicks, oftentimes, they can really kill you if you're just solely going off your imbalance, right? So let's say as price gets in, we take our entry off the 50%. The way that I structure it and the way that I have my stop loss set is, one, depending on the range, right, how big it is. If it's a huge, huge range, oftentimes I'm not letting it get all the way down to this swing low. I'd probably just wait for a candle close right below that 0.79, and if that happens, I'm out. To me, that would show me some willingness to go lower and take out that swing low. But in a range like this, where it's really not all that big, and if I'm looking at a 30-minute time frame, this is not going to be like a day trade for me. This would be a longer term trade. I would have my stop loss essentially right below this swing low right here, because what would happen if we took out that swing low? To me, that would be a market structure shift, right? So I would have my entry somewhere in below the 50% level, ideally between this 0.62 to 0.79, in some sort of imbalance, which is, it looks like a little gap in the chart, right? A volume imbalance, gap up. You have fair value gaps right here. You have bullish breakers. That's another concept that he teaches. You can look at it if you were more interested in that. An order block, another concept that you can look at. And I'm using one of those. I'm not just solely going off of the Fibonacci's, right? Does it work sometimes? You're going to see in a second how it does. But to me, that's not giving me the level of confidence I need to feel safe in that trade. And again, I do take quite a few trades because, again, like I said, right now we're looking at the 30-minute. We could do this on the 5-minute chart as well. So it does occur quite often. And of course, they're not always right, but more often than not, they play out pretty dang well. And, to me, the highest probability is when you get one of these bullish imbalances in this happy zone, right? So we talked about imbalances. We talked about our market structure shift. Now, just to briefly talk about, the concept of liquidity and where would I be searching for liquidity or my profit taking target, right? So we have liquidity resting here. We have liquidity resting here, which is our swing low, right? And we have liquidity resting here, which is our swing high, right? That we just set following that market structure shift and break of this recent high. So as price gets down into this area, I'm looking at my first target being this high right here. So just getting back to the high in the first place, that could be target numero uno, right? And from that point, that's a pretty decent trade, right? So let's say we did enter it off the 50% and we got in at 445 and we took that thing up almost $2 just to get back to our recent high, right? So from that point, that trade would work out solid, right? So we reach above and we take liquidity. Now, first target, depending on, what kind of trade you're taking, do you have time on the contract? Or are you trading short-dated contracts like I typically do? In that case, I'm usually a little bit more quick, and that's why if you see my videos, you'll see me sliding my stops up in profit once we hit specific zones. So, for me, if I'm carrying multiple contracts, my first scale out would be up at this area, and I would be moving my stop loss above, maybe a newfound, imbalance or something like that. And at that point, if it were to come back down and take me out, so be it. But I'm locking in points regardless. I'm not going to go and let this good trade go bad. So that's why I move my stops in profit. And in addition to that, NASDAQ is $20 per point. That can turn into a lot of money. I actually have a trade today that I kind of fudged up. So I moved my stop up, but I was being a little more stingy with it and not moving it as high as I probably should have because I wanted a higher target, and I got stopped out of that trade. We ended up just chopping, really. I didn't miss out on too much until way later on in the day, so it didn't turn out to be a big deal, but I did, let a couple $100 just kind of fade away from me when it was pretty easily avoidable. So, but as we continue here, we come up, we take liquidity here, and after that liquidity grab, what do? We don't break out, right? We pull back and we head lower again, back to where? This golden pocket area once again, and we start to make our move higher just again. And this is active. This is what we're seeing. Today is August 14th. I'm actually making this video at midnight on the 15th. So as you can see, we make that run up higher, get back down into fair value gap here, and we take off again. Now, the way that I look at it from a short-term time frame perspective, like I do intraday, once we take out that high, for example, we take out this high here, this is all I'd be doing. Oh, not that. Whoops, let me leave that down there for a sec. This is all I would be doing. And looking at the same type of setup here. So what price run was it that took out this high right here? It was this one. Boom. Did we get back down into 50%? Nope. Not a trade that I would ideally take. Did I miss something? Yeah, I did for sure. But in terms of risk reward for me, this is where I want to be adding off of to be taking this thing higher. So that's just one example right there on how my model in a nutshell. We could take a look at Apple here. Apple's got something very similar here in that we set our low, right? Bounce perfectly off this bullish. If you're looking for a market newsletter, check out mine, Markets with Mando. It's recently been featured on Benzinga, Webull, TOS. First month free using code August100. I'll put the link in the bio. Imbalance from the other day. We took out swing high right here. Market structure shift. Right here, our imbalance is right at 50%. Okay, so that kind of throws a little bit of a wrench in things. But right here, we have a bullish order block. And on the 5-minute chart, I'm not in love with taking order blocks in this type of situation. I really prefer the bullish fair value gaps or volume imbalances, or breakers, or maybe we're at the new week open gap, things like that. I would value more than a smaller time frame order block. That's just me. That's how I feel about it. From back testing, if you feel differently, drop a comment and let me know. But that's just how I kind of feel about it. But anyways, still stay true. This, we remain into this bullish imbalance here. Never drops below what, essentially our stop loss would be in this situation. Now, again, if the risk is too much for you, you have to be able to map that out yourself and identify, okay, my risk is different than Mando's. Maybe I got way more money than him and I can risk way more. Or maybe, I don't have as big of an account and I can't, right? So what? Who cares? You just have to be able to identify that for yourself and just have an understanding of, if price gets down to here, where's your contract going to be at, right? Whatever you're trading, where are your shares going to be at? What's your position going to look like? You have to kind of forecast that before anything else, or you're kind of, you're playing with fire a little bit. So regardless, this works out a little bit more sloppy, but we really held on to this throughout. Still held within our 0.62 to 0.79 and this bullish order block right here. And we run higher. We don't quite make it up here. Takes one more chance. We actually gap up, take out liquidity here. And as we simmer back down into our bullish imbalance at the 50% level, we take off again and continue higher. So a little bit more sloppy, but still concept carries, right? Just for time purposes, we'll keep on speeding through because I got a couple more I want to show. Here's Tesla, same situation. Find support, take out a high, set our range, right? Boom, boom, here's our range. We get a dip into a bullish imbalance in discount or below the 50%, and we start to move higher. This one didn't even take place yet. We do have a pretty substantial gap down or bearish volume imbalance here. So would I expect an explosive move? Not necessarily, but still the same rules would apply. Like my take profit would be here and my stop loss would be under here. So always well-defined risk. I'm never going into it not having an understanding of where I would be stopping out or where I'd be taking profits, right? Profit target number one. Next target for me would be our next swing high, or our next area of liquidity, which is another 4 points higher, 3 points higher. Again, here's another example, and this is actually an example where one that I probably would not take. So as you can see here, what price run was it that we took out this swing high right here? This is, right, we can all agree that this is the most recent swing high that we had made, right? We could also look at it like this. If you wanted to say, okay, we took out this little high here with that price run, you could look at it like this. Same situation. Boom. Got into our 0.60 to 0.79. Take off. Okay. Boom. Next. What high took out, or what price run took out that high right here? This one, from low to high. Right. We get our retracement back down. And while our little 0.62 to 0.79 golden pocket area holds up, right? Wicks do the damage. Bodies are what kind of telling you the story, right? So the wicks will give you the heart attack, but bodies held this the entire time. So as clean as this might look, to me, this is not a trade. One, all we have here is really an order block that makes me feel any sense of confidence. There's no imbalances in this area here. To me, not something that I'd be super interested in taking. Now, following this move, and as we break above liquidity, we do the similar type of situation right here. Boom. We can scroll on over, right, and come to this point. What price run was it that took out this high here? It was, boom. Okay, just like Apple, or was it Apple, or was it SPY? I forget. One of them. Price runs higher, takes out swing high, retracement back lower. Did it get into discount or below 50%? This would be the one that I'm looking for. Did I miss it? Yes. Am I gonna cry about it? No, not really. Just as a way to control my risk. There's many other things I can trade, and these occur, multiple times throughout the day. But we hit a volume imbalance here, and we took off, created another imbalance in the process. Let's see, Amazon. Let's see, was this one that it was pretty beautifully? No, this is another one where, did it work? Yes. Would it be one that I would take? Not really. So again, we actually didn't even take liquidity on Amazon here. We were kind of stuck within a range. So you have your swing low here, or swing high there, sorry. Come on down here, boom, price runs higher, takes out this swing high. Here's our range set. Price retraces back into where? 0.62 to 0.79. Yes, we do chop around. We actually made relative equal highs. So retail traders who believe in that kind of stuff are going to say, oh, look, double top, oh, triple top, what? Nope, you're getting ripped. Boom. That's a lot of liquidity there. Market's going to search for that and rip their face off. So again, you can look at it from this perspective, just like we did on the other two. Okay. Now, what swing high was it that what price run was it that took out that swing high right here? It was this one. Run up, retracement where? Beautiful, 0.62 to 0.79. We have a bullish fair value gap right here, and boom, take off. Perfect. Right, and here's the last one, and this is even on like a name that might not get as much love, because it's it's not a mega cap or anything like that, but similar situation. What price run was it that took out this swing high here, low to high, retracement back lower, did again to 50%? No, I'm not interested. Price does run a little higher, takes out a high. As we come back down, same range. Where does price retrace into? This bullish volume imbalance, which is a gap essentially. Sometimes you even get these on a 5-minute chart on ES, so that's why I think they're so valuable, because they do act as support, and people often don't even look at them like in that way. So, and that's another thing, the whole way I play gaps and stuff. I can make another video about that another time. But price gets into this 0.62 area here, boom, we hold it. Did we take out the swing low? No, you never would have got stopped out. So the wick would have given you a heart attack here. Body held, and we took off. Head up towards, did we take out first target? Yes. What would our second target be? It would be our next swing high. So this one essentially. Did we reach it? Yes. In this situation here, could you just keep sliding stops up into profit? Absolutely. And that's the way I typically do it. Not many of my trades, if you look on Instagram, TikTok, even on Twitter, X, whatever it is, you'll notice that a lot of the times I let that thing run until it doesn't want to run anymore. So am I missing out on a couple of bucks? For sure, but I would prefer doing that than to be taking profits when I think there could potentially be more to it. So really that's all I have. I mean, here's just one more quick brief example. I mean, this is even on the daily time frame. This is what I've been looking at, and I don't want to say I was bullish over the last couple weeks. Do I expect higher prices? I am in that bull camp. It's just my thesis, but I had a good feeling that we were going to come back down. Look, so again, which price run took out the high? Boom, right here. This is your swing high that we took out with what? This price run. Bang, right? And here goes back to that point I made before. Do I know where the top is? I could have thought this was the top of, this specific range. And look what would have happened. Yeah, it would have been, in the green for a little bit, but bang, range was not set. So that's why when we're in a bullish trend, I try to avoid shorting these moves down. Does that mean on a daily time frame I didn't take any short over the last 2 weeks? No, the 5-minute chart is completely different. But just, for the purpose of understanding, if I was trading on, say a daily time frame, I would expect this to happen. I just don't know where the top would be. So I would wait for some sort of imbalance to form, i.e. this, right? And that would give me a little bit more of an indication that we are going to head down. Now, I ran into a little bit of, I don't want to say trouble, but, I was, to me, I was kind of fighting with myself. Which imbalance did I think would be more favorable for a bounce? And, as we could see so far, this is still, we really haven't made up too much ground. We are down quite a bit from our highs, but we set our range. We retraced back down below 50% into a discount fair value gap, while the bodies still have held this bullish fair value gap right here. We did dip into this one with wicks, maintaining the 0.79, and we started to make a little bit of a move higher. And again, this is for me, I've been saying it on Twitter, this right here, if this were to fall, that would be a market structure shift to the downside, and at that point I would start to be a little bearish. Now, even with that break, I would still expect a move back up into, again, we could just flip this thing around, but it's a little bit more difficult to do with ES right now, because every single time this has happened, it's been a run. I mean, let's see, we could speed through this really quick. I know this video is pretty long, but again, this is essentially everything that I'm trading with. So let's see, first one took out that swing high with what price run? It was this one here. Boom, boom. Where do we retrace to? 50% fair value gap. Boom, take off. Same situation. Where do we retrace to? Boom, take off. And we can literally just walk the line up this entire way with this exact setup. So this high taken out with what price run? Boom, boom. Where do we get to? 50% take off. Okay. And we can keep doing this. So this swing high here, what price run took it out? This one right here. Boom. Okay, where do we retrace to? Discount below 50%, fair value gap. Boom, take off, back to the highs here, and so on and so forth. So yeah, that's all I got. Sorry, this was a little bit longer than I had anticipated, but this is literally, that's my model right there, and that's what I use on a 5-minute time frame, 15-minute time frame, 30, daily, weekly, whatever it may be. This is what I'm using. I am working on incorporating one little thing that I think will be good when there is some downtime on some of these retracements and stuff like that. So well, I hope you liked it. If you made it this far, congratulations. I appreciate your support, and shoot me a message if you watch this video, and let me know what you think. Most of my videos from now on, I'm gonna kind of retrace back into this video and kind of show how it may have played out, may have not played out, and kind of how I manage it. So until next time, I will talk to you soon.